wanna shake that ground.
Charitable Remainder Trust. And it's kind of a very unique tool. And it has to do with the creation of a trust. And that's what this box is right here. This is a trust. And this is a very specialized trust. It's called a Charitable Remainder Trust, which means there's a charity who's the back-end beneficiary. They are the charitable remainder beneficiary, not your kids,
right?
Charity. That's what's important to remember in this particular case. We do have variations of this, but this is the general idea.
And this is a trust you set up, you draft.
Yes, that's right. This is more of an advanced. You want to work with a professional on this. This is not pull off the internet stuff. This is more advanced planning. But you would take an asset, and typically we use this as a highly appreciated, underproductive asset. And the various example I use is simply a piece of real estate. Let's say a retired person, someone who's a little bit older. They have bought a piece of property that they're renting out. They bought the property 30 years ago for $30,000, and now it's worth $1 million. Okay, the highly appreciated, but they're only getting $4,000 a month in income. You see what I'm saying?
Right.
You have a very highly appreciated, underproductive asset. Somebody who's a little bit older, maybe, well, it doesn't have to be, but in my example, a little bit older, they could really use more income, but they can't. They're afraid to sell the property because they're going to get clobbered in capital gain taxes. You got this huge growth of $970,000 in my example. So what you can do is you can take that highly appreciated, underproductive asset, put it into your charitable remainder trust, and because the charity is on the back end, the trustee sells the asset. You got to be willing to sell the asset. Okay, it's important. When you sell the asset, now you've created $1 million bank account. It's not $1 million less capital gain. You got to avoid, at least for the sale, you avoided the capital gain tax.
Right, total value goes in there.
The full value goes in there. And the reason why is because this trust has a charitable beneficiary. I call this a charitable partnership. You're going to get benefit today by not paying capital gain tax by having a charity on the back end. Okay, so what does all this mean? You create the trust, and then number one, donor funds the trust. You take the highly appreciated asset, you put it in the trust. Because it's a charitable trust, now you get an income tax deduction, right? So you get a present income tax deduction, which goes back to our opening comments, nature, who the charity is,
right,
the type of asset going in, and your adjusted gross income, how long it goes out for. So you get an income tax deduction, and then that immediately increases your income, and then it produces an income. Now the money is in a brokerage account that's producing an income, the full $1 million.
So you can take that $1 million and you can invest it and diversify it
right
the way you want, working with a professional, and kick off the income. And
that income comes back to you. It comes back to you. So back to my example of the retired individual. They were only getting $4,000 a month, but they don't have long-term care insurance. Maybe they don't have enough money for their retirement. Maybe they want to help pay for their grandkids' college education. Maybe they want to take a trip around the world. It's your money. Do whatever you want with it. So what you do is you put the money in the trust sells it. You get a present income tax deduction, and you get an income stream. I'm going to share with you on the next slide, an income stream. And then when you pass away, whatever's left inside this trust right here goes to over here, step 3, goes to the charitable beneficiary, okay?
So Brad, this gets into, as far as making the donation, it can be highly appreciated asset, it could be stocks, it could be property, can it also be a business, right?
Yeah, you bet, that's right. And that's one of the ones that we use here, the example. So thanks for bringing that up. So some clients, let's say they're going to sell the business, okay? And they say, well, I'm going to have a $10 million windfall on the sale of my business. I'm going to get clobbered on capital gain tax. I started my business for $1,000. I'm going to sell it for $10 million. You can imagine the capital gain that's going on here. So if you take the full business and you put it inside the CRT, the Charitable Remainder Trust, I'm going to show you there are some limitations as to how much you can take out. there's limitations the government puts in because the intent is that on the back end, there's supposed to be some money left over for charity.
Right. It can't go to zero.
Yeah, you just can't put $10 million in, sell it, and take $10 million out and escape capital gain tax.
Right.
It's designed to pay out over your lifetime, and there's something designed to go to the charity. I'm going to give you the illustrations in a second. So there's limitations on what the person gets back. And some people are like, listen, I got my one windfall. I want to have my mad money. I don't want to deal with these scheduled payments per the government's prerequisites. So I say, fine, let's just use maybe 50%. Maybe we'll take half the business, we'll put it in the CRT, and half the business you sell. So the half that you sell in your name, you pay the capital gain tax, you get your $3 million net, whatever it is, and you go crazy with it. No limitations, no whatever.
So you can do that. So if you're selling a business, you can break it up and just put half of it in the CRT?
That's right. And then what happens is then the part that's in the CRT, you then sell the other half, $5 million, you would sell with no capital gain tax and get an income over the remainder of your lifetime. So it's a little bit of a balance. Every client, I've done it 70-30, 30% CRT, 70% takeaway. I've done it the opposite, 70% CRT, 30% takeaway. It's just a matter, again, of the overall financial analysis. You cannot do this type of planning without having an understanding of the client's overall financial needs.
Well, yeah, because as you're talking about this gets into, okay, big picture, advanced planning, financial planning, and how you're allocating these pieces. And somebody could say, okay, it's great, let's carve off half my business, sell it in CRT. Right. I'll live on the income, and then you can even replace that money, which I think you're going to talk about here, in the CRT with an insurance policy.
That's right.
So there's a lot of strategy.
There's totally flexible. That's right. And as I mentioned when my first comment is this is never done in a vacuum. We always have to do this in light of a financial analysis. So that's absolutely a good point. So what I want to show you here is we do wind up using, as you mentioned, a wealth replacement trust. I'll get over this in a couple of minutes. So this kind of show you how the circular transaction works. So the donor creates this charitable remainder trust. They fund the assets in, right? The assets go in.
Right.
They get a present income tax deduction that comes back out to them. The donor gets the income tax deduction. And the investment portfolio, and in our case, our full $1 million, no capital gain tax, our full $1 million is now generating an income monthly, quarterly, semi-annually, and however we set this up, typically it's on monthly or quarterly, is now being paid to the donor. So we've created this circle transaction. But as I mentioned to you, because it's a charitable remainder trust, if I put $1 million in, what did I say earlier? That for every action, there's an opposite and equal reaction. I said, if I'm putting $1 million into a charitable entity, who's not getting the $1 million?
Your beneficiary.
The kids, right? So sometimes we don't want to disinherit our kids for the benefit of the charity. So as you correctly mentioned, many times we use a life insurance policy. We put it into into their trust. And how much insurance do we buy, Paul? The $1 million that we otherwise gave to the charity. So if we disinherit our kids for the benefit of the charity on one side, we simply replace that with $1 million life insurance policy on the other. And people say, well, wait a second, but I'm older now. It's $1 million is expensive. That's where the income over here, the income being generated from the CRT, is used to supplement the cost of that life insurance policy. And I'll show you in a second. So effectively, the insurance winds up costing you nothing because we've created this income producing machine that pays the insurance policy, and you're still going to have money left over for your retirement, long-term care, college, trip around the world, etc. Very
interesting. And let's say you put a business in there and and you sell half or all the business, whatever it is. Then you have the wealth replacement trust. Is there an analysis of what type of life insurance goes in there? Because are you building up then cash value life insurance in the wealth replacement trust?
Yeah, no, typically this would be either, it depends on if there's a surviving spouse. Maybe it could be a second to die policy. It could be an individual policy. It could be term. It could be whole life. There's all kind of variables based upon age, type of assets, with economic needs.
Okay.
Yeah, so again, getting back to our team approach, you got legal. That's me helping design the estate and the advanced charitable plan. You got the financial planner making sure all this stuff works within their overall financial and retirement needs, part of the exit planning as well. And you got the insurance professional to find out what's the best way for the insurance to work if we're using that as a wealth replacement tool.
Right.
So that's why I'm saying you don't pull this stuff off the internet and just do it, because as you can see, I said this was the more complicated, it's the most powerful tool that we have, but at the same time, it does take a bit more of a comprehensive approach. But I don't think that this is over most people being able to understand. It's just, it's a little foreign for some folks.
Right.
So effectively what you're doing here, my example, we took a house and then you have to sell the asset. The house is sold, right? That's the machine that creates the income, okay? That income is then used to buy the life insurance policy. And that's how everything stays for the remainder of your lifetime and the remainder of your surviving spouse. Sitting on the back end over here is the nonprofit. Nonprofit is really getting nothing during your lifetime. Nothing. All the deductions and all the income are flowing to you or your spouse during your lifetime. Okay? Lifetime. They are the charitable remainder beneficiary when you die. And you got a life insurance policy that's sitting over here doing absolutely nothing until you pass away. When you pass away, those life insurance death benefits go to your kids to replace the wealth of the house that you gave away. See how it fits together?
Right.
Okay. So I did this analysis for a client of mine. This is 2016. The numbers are off, but the concept is the same. So here we took a $1 million asset. That was the fair market value of the asset. We put it inside our CRT. I'm getting an income on this portfolio at 5%. Okay, well, this hypothetical, but just 5% income. Here is my donor's deduction. Remember, 10%. You get a 10% charitable deduction. We put in $1 million up on top. We get a $100,000 charitable deduction. So that now goes on our present income, our 1040, and rolls over for 5 years. So again, you're getting immediate income tax deduction, which means more money in your pocket. Now, the cool thing about this is right here. One of my favorite things to show is this. Here on year one, we start with our $1 million. We have our 5% growth, which is my principal income. Now, you have to distribute a certain dollar amount per year per the IRS schedules. And my client was what? How old are they? Oh, 65 years old. I have right here. So per the IRS schedules, my 65-year-old person is going to live 17 years.
Right.
So I got a 17-year payout, and we're paying this out quarterly. You see this? So quarterly for 17 years, this is the distribution of year one. Look at this, Paul. $193,000 will be distributed to the client year one.
Year one.
You take out a little bit of capital gain tax. You take out a little investment. There is some tax that comes out, but the lion's share, $193,000, comes out in year one.
Yeah.
Back to my little old lady. She's got a $1 million house. That's giving her $4,000 income. She doesn't have long-term care, doesn't have retirement, wants to pay for kids' college. Look what we did. We created $193,000 in year one, capital gain tax-free from the get-go. And now the remainder for year one, after she makes her deduction, is $853. So her opening balance in year two is $853. It's earning 5%. So now in year two, she's going to have a withdrawal of $164,000.
Jeez.
And then look at year three, 5%, $140. It's a decreasing amount because you're taking money out. But if you look at the numbers, 193, 164, 140,000, 120,000. If you go down over the full 17-year time period, based upon the calculations, she's going to take out $1.2 million of distributions when she started 17 years ago with only $1 million.
Right.
Because it wasn't, she got to avoid the capital gain tax and it got reinvested over time. The tax bite never quite caught up with her. So this is what she gets during her lifetime.
Amazing. I mean, it's
totally
it's
incredible.
Yeah.
And this goes back to, I was telling you, yeah, but she's 65 years old. $1 million policy is going to cost her $30,000 a year, Paul. Okay,
right.
Great. Look what I generated. I generated $193,000. if I pay the $30,000 insurance premium, she still is going to walk away with $166,000.
Right.
It
Yeah.
works.
Yeah. The numbers add up.
The numbers add up, right? Now, I told you also that it's a charitable remainder. So what happens if she dies at any time during this 17-year time period? This is the remainder category. So say, for example, she says she gets so excited over the first handful of years, she then has a heart attack and passes away, God forbid. Right? You got to laugh about these things.
Right.
So let's say it's year 6. So she passes away in year 6. The amount of money still sitting in her bank account at that time is $386,000, right? Because remember, she took these distributions right here, right? She started with $1 million, distribution. And year 6, her remaining balance in her brokerage account is $186,000. When she dies, that's what goes to the charity. So she now left a $386,000 legacy to her charity or charities of her choice. Okay.
Amazing. Yeah. No, it's fantastic.
Yes. So getting back to my example over here. So here, remember our donor put that property inside $1 million property, sold it, turned it into cash, created our engine, which creates these distributions. Okay. During her lifetime, she dies. Now she dies. This over here in green is what goes to the charity. That's what drops down. But when she dies, the life insurance policy also turned into cash. So the remainder from the charity goes down to the nonprofit. That $386,000 goes down to the nonprofit. You see that?
Yeah.
And then the kids, they get the full $1 million from the life insurance policy.
It's pretty amazing. I mean, it's amazing. Yeah. It's just
yeah, think about it. The kids live in New York. They say, Mom, I don't really want your house in Southern California. I'd much rather have $1 million income tax free from a life insurance policy than to deal with this old rickety broken down house in Southern California for $1 million. When you look at this, Paul, I call this a win-win-win.
Right.
Everybody wins here. The lady in our case won because she turned a highly appreciated, underproductive asset into an income producing machine for her, right? She wins. The charity wins because they got a large charitable deduction, in my example, on $386,000, whereas before she was giving them $36.
Right.
See, now planning with your head and not with your heart, right?
Yep.
And the kids win because the kids got the $1 million asset, income tax free and estate tax free from the life insurance policy to replace it. And if you think about it, Paul, in most of my clients' case, what did Uncle Sam got? Uncle Sam got nothing. It was in a complete estate tax free. So that's win number 4. She wins, charity wins, kids win, government gets nothing, we all win.
There's a loser in there, but we don't care.
This to me is the most powerful arsenal that we have against the modern attack on the accumulation of wealth, period.
Yeah.
This is it.
And I've heard you talk, Brad, when you're sitting down with clients, and you kind of briefly mentioned it, the way to look at this, for anyone that's watching this show is it's a big picture analysis.
Yes.
It's looking at all the pieces, and it's almost like an architect going in and building something. You got to look at how everything fits together. Is this right? And and carve it up. And it just seems to me that's kind of the right way to do it.
Yeah. So hopefully you can feel my enthusiasm coming through the screen here, because charitable planning is just such an important component. I think not only for an individual, but also for society. And as I tell my clients, when you get taxed, income taxed, capital gain tax, investment tax, estate tax, it's not your dollar. It's social dollars.
Right.
The government takes it and applies it to the social welfare. It's not your money. It's social money. So the question is, do you want to direct the social dollars, or do you want Uncle Sam to direct the social dollars? And charitable planning allows you to take those dollars, that tax dollars, and directing them in the direction that's important to you.
Right.
You can see there's so many benefits to doing this type of work, and it doesn't have to be at your cost. It's not a one-way street. It's not just you give, and you and your family suffer because your heart is bigger than your head.
Right.
This allows the opposite. You benefit too because of what you're doing with the charitable partnership.
Love it. Love it. As usual, great information, Brad. Thanks so much. And thanks everybody for jumping on. Bye-bye.